live from Tokyo is Harumi Taguchi, the principal economist at S&P Global Market Intelligence. Ohayo gozaimasu, Harumi-san. Welcome to the program.
Good morning.
So you've projected inflation to moderate in line with an improvement in crop yields in the second half of this year here in the Philippines. But what now? With crude oil on a volatile path here following the escalations and de-escalations that we've seen in the Middle East over the past 48 hours.
Yes, as previously, we anticipated oil prices to decline below $60 per barrel in the second half of this year, and the CPI is moderated to 1.1% in July, and this was anticipated gradually increase due to the waning of the base effect from the high rice prices last year. But still, we expected the CPI was remain below 2% in the second half, and the annual average inflation of this year was forecasted at 1.7%. However, the recent development seems to be increased, coupled with the weak peso, more likely to elevate the CPI inflation.
Interesting dynamics we're seeing, Harumi-san, because there is oil prices on the one hand and rice prices on the other. So given these two variables, if you will, how do you think that inflation projection is going to change in the second half?
Well, the situation is still uncertain, but assuming the oil prices stay around the current $75 per barrel and the peso remains at the current level through this end of the year, and then we expect the average CPI inflation of this the second half of this year with the average approximately 2.2% and the annual inflation also will be less to 2%. It really depends on the situation of the oil prices. Also, this depends on the food crops.
Yeah, there's just so much variables there that we can't pin it out. But what we're really interested in is the impact on consumer spending, because there's a significant weight of food and energy in household spending. So given your projections in food and energy prices, what impact might these have on private consumption here in the Philippines?
For now, food and energy prices are unlikely to significantly impact private consumption, given that the wage increase is still solid and then the remittances is still not affected by this geopolitical situations. However, if the adverse weather as it disrupts the crop yields and also the oil energy prices against the surge further due to the prolonged closure of the Strait of Hormuz, or this escalated the situation could again to affect the energy prices and the electricity bills, and so that probably gradually has weighted on the private consumption.
Well, I spoke with the Bangko Sentral governor himself, Eli Remolona, last Friday on this program, and he said $100 a barrel is the biggest risk. What is that going to mean for monetary policy outlook if we take a look at the worst case scenario?
Yeah, if the oil price is moving up over the $100 per barrel and this persists, this inflation rate probably going up to more than 4% in the first half of next year. That means that in that such scenario, BSP is more likely to consider to raise its policy rate.
So where does that put now the global trade tensions that we worried about at the start of this year as a risk to the Philippine economy? Trump's tariff pause still ends in less than 2 weeks on July 9th.
We currently assume country level the tariffs will be staying 10% for a time being, because many U.S. trading partners still negotiating with the U.S. And also the rules by the Court of International Trade is invalid the tariffs, because it's stating that the president is misusing the international economic power, international the act. That means also increase the potential to hold at the current level for time being. But there's a couple of scenarios afterwards, since if the court admits the Trump administration's appeal, then the reciprocal tariffs could be introduced as he originally announced, or the negotiation would be success and then going to be agreed to 10%, staying on the 10% with some condition, or agreement with this between 10% and then originally announced. Otherwise, if the policy dismissed the Trump administration's appeals, that probably the administration needs to suspend this 10% tariff. But even so, the production level tariff is imposed by the Section 232 regulation will still remain at the place. And also another additional tax will be scheduled to including that of the semiconductors. So direct impact of this tariffs on the Philippine economy are relatively smaller than many APEC economies, since we estimate the additional tariff costs caused by 70% of the reciprocal taxes to be 0.4% of the GDP, which is smaller than many other countries. And the magnitude of impact, including the indirect impact, depends on the scenarios. And in any case, this trade type of the tariff will slow global economic growth and disrupt the supply chain.
All right. Well, it's good to hear a silver lining there, despite what's going on globally. Thank you so much for joining us for the insights, Harumi Taguchi of S&P Global Intelligence.